Hello everyone, and welcome to the TechHub.training Excel solution for the Chettinad, Chaats, and Curries challenge. For this challenge, we've been asked to manipulate our data in Excel. Now for this challenge, it's just a little capital budgeting problem, and so we've got two alternatives. Either purchase a new appliance or keep and repair the existing machines that we have. Okay, so based on the information that we received for each alternative, we want to calculate these cash flows and then of course the net present value and internal rate of return, and ideally those numbers for each alternative will help us determine which alternative is the better investment to move forward with. Great, so let's go ahead and hop in. We'll start with our initial outlay here. As far as the design costs go, some of you may have been tempted to put $3,000 here because the case does specify that we spent $3,000 3 months ago to develop the plans for this new appliance. The thing is, that money was already paid, and so regardless of whether we decide to move forward with option 1 or option 2, we're not getting that money back or saving it. And so that's what's known as a sunk cost, and we're going to leave it out of our analysis for that reason. As far as these costs go, they were given in the case. I think we have some percentages here, but you can do a quick little calculation there to get those. Then, in addition to equipment costs, we also have a few more things that we need to take into consideration for our initial outlay, the first of which is this tax credit. Okay, if we decide to move forward with option 1, we will be scrapping our old appliances, and that's because they do have some book value remaining, but they're not worth anything. And so we'd be taking a loss, and you can find the tax credit just by multiplying that loss by the tax rate. Great. Then we also need to take net working capital increase into account. One thing to note, this $2,500 here, this is not the total amount of net working capital that we need to operate our business. This is just the net working capital that we need in addition to what we currently use if we decide to move forward with this alternative. Okay. Great. Then we also have some revenues from the space that we can lease out. We're consolidating things down from 2 machines down to 1, and so we'll be able to lease out that space. I think it was for $5 for every square foot. Great, and then we also have labor savings and maintenance savings to take into consideration with this hypothetical. And then of course depreciation expense. So with all of those here, you can find your earnings before taxes, multiply that by your tax rate, and you'll get your tax liability. And then summing those together, you'll get your net income. Perfect. Now that's not going to change for the remaining years of operation here before we liquidate. The things that will change are one of the things that will change is, of course, is this net working capital, okay? The case specifies that we're going to increase 20% for the first 4 years, and then as we start to wind down the business, we'll scale things back by 10% until we eventually liquidate. Now that's a good number to know, but the one that we really care about is this change, okay? The change in net working capital from year to year is actually what we have as far as cash flows, inflows and outflows, all right? And so the total net working capital needed, total excess, I guess would be a better name for it, but it's more of a means to an end to get us this number here. Perfect, and then of course because depreciation is a non-cash transaction, we'll need to add that back in, and this will properly reflect our cash flows. Then I guess for our terminal cash flow year in year 8, we'll need to incorporate this salvage value, but if you add all of those things together, you'll get our cash flows here. Right after we have those, we are prepared to jump into our financial formulas, okay? Just because of the way that Excel does their formulas, or does its formulas, anything that you throw into this formula here will be affected by this required rate of return. And so I only want to do years 1 through 8, or include years 1 through 8 in this formula. The reason why we leave the initial outlay out of this is because that's what we're paying now. There will be no time value of money effect on that. So you can just add it to everything else. And that will give you your net present value for this alternative. And then for the internal rate of return, there's nothing shifty that you have to do there. You can just throw all of your cash flows into that single formula. Great. After doing that for alternative 1, it's pretty much the same thing for alternative 2. The only initial outlay costs that you'll have are the repair costs, and that's your direct labor and parts, which was $7,500. You'll need to add that to your book value in order to get the total old machine book value after the repair, and then that will help you find your depreciation here. Then you got earnings before taxes. You're at a loss, so you'll take a tax credit there, and then that will give you your net income. Of course, add back depreciation, and then we end up with our cash flows here. Great, and you'll do the same thing for alternative 2 as we did here with alternative 1 to solve for those financial formulas. Then you can see the alternative 1 is slightly less negative, and it's got a positive internal rate of return. And so clearly this is going to be the better alternative that we want to move forward with. Thanks again for joining us for this challenge. If you've solved it a different way or you have any other cool insights, go ahead and drop those in the comments section. And yeah, we'll look forward to seeing you for the next challenge.